as part of series of Indian economy, we started discussing with measures of national income and growth. Then we discussed about the topic related to inflation, monetary policy, and last part of our discussion happens to be on public finance. So as part of public finance, we understood budget of this particular year especially, and then we happen to look at the taxation issues, various terms related to taxation and the issues related to taxation, and as such we also happen to understand the purpose of introduction of VAT and GST. Now let's go ahead and understand one most important topic for your examination, that is money and banking. So let's start with money. So how would you define money? Money is simply defined, in fact there is a very crazy and simple definition of money. Money is what people accept or believe as money. You have 2000 rupees with you. The reason why you believe 2000, because you believe that everyone in the country also believes it is 2000. That's it. That's a simple definition of money. So broadly, there are 4 different functions money source. The first function money source happens to be is that it acts as a medium of exchange. It acts as a medium of exchange. Does mean it facilitates facilitate exchange of goods and services. In a simple terms, money could be used, could be related to lubricant. So money could be simply defined as very similar to lubricant of a vehicle. So as such, you know, too much of lubricant is bad and too less of lubricant is also bad for the vehicle. The same whole thing, the same thing holds good even for money. Money facilitates exchange of goods and services, acts as a medium of exchange. The second important function it happens to serve is it acts as a unit of measure of value. Unit of measure of value. So like we already discussed in one of the previous classes, the measures of national income and growth, I happen to explain the difference between nominal and real GDP, and that's the time I explained how exactly, what exactly is the meaning of unit of measure of value. So like we express, we have units to measure distance, we have units to measure frequency. Similarly, money serves the purpose, that is, it acts as a unit of measure of value. You could express the value in certain units. In India, we happen to choose the unit that is a rupee, whereas American happen to choose an American dollar. The third purpose money serves is it acts as a store of value. Even value could be stored, isn't it, in the form of money. So if you happen to have money with you, that means you are storing value. That means this money could be used to purchase certain basket of goods and services in the future. The fourth important function money is said to serve is it acts as a means of deferred payment. Means of deferred payment. So any payments that could be settled in the future could also be made through money. Means of deferred payments. So these are the 4 different functions money happens to serve, and anything could be called as money if it happens to serve any of these 4 functions. Take the case of gold. Gold could be used as a medium of exchange. If I am paying you gold in return for a service, then people would be happy to people would be willing to accept it as a medium of exchange. But the problem with gold is it's not easily liquid, isn't it? If you want to simply convert this gold into some part of salt, so it's not very easy to convert, or what proportion of gold you would like to exchange in return for 100 grams of salt or 200 grams of salt, isn't it? So that's the basic reason the value of every commodity cannot be expressed in terms of gold. So it does mean, the value of every commodity cannot be expressed with the units as gold, and that's the basic reason, since gold doesn't serve one of these 4 different functions, and that's the reason why people generally doesn't use gold in the modern days, isn't it? So ideally money, the fiat currency that right now we are using, when I say the word fiat currency, fiat does mean by law or by order. So the paper currency that whatever we have in our pockets is simply the currency the RBI prints, and who is backing it? The government of India. And who is guaranteeing this currency? The government of India. Since the government says so and RBI printing with the backing from the government of India, it is a currency, and that's the basic reason we call this currency as a fiat currency. By law or by order, this is a currency. Now just let's have a glance of how the money happened to evolve. As such, you are all aware of the fact in good old days people used to go for barter system of exchange, but the problem of barter system is there should be double coincidence of wants for any exchange to take place. For any exchange to take place, there should be double coincidence of wants. So your want should coincide with the wants of the other person. Only in such case an exchange of goods and services takes place. Later on, people happen to move from barter system to commodity money like seashells, and then metallic money, then gold and silver used to be used as a currency. But as of now, you know the fact that this fiat currency, the paper currency right now, the government of India happened to print, or the RBI happened to print and circulate, is based upon a system called minimum reserve system. Minimum reserve system. So it has been by maintaining a reserves of approximately 200 crore rupees of worth of assets. mostly in the form of gold and forex reserves, the RBI has a right to print any amount of money as per the requirement of the economy. So, this money that is printed by as of now is by maintaining a minimum reserve system, and this is the reason we happen to call it as a fiat currency, and this currency is not backed by any asset. So, this paper currency is that's what we are circulating right now. And in the modern days, because of the payment system and the information technology evolved, we also have these plastic cards which could be used, the debit cards that are also being used as a replacement of this liquid cash. And the modern days, we also been aware of the fact, most of you at least looking at this particular picture, you could also make it what is called as a Bitcoin. Is it the digital currency or digital, the cryptocurrency that has become more popular. But the difference between these particular currency, let's say the currency that you have in this particular picture and the currency is that the first one happens to be issued by a central issuing authority. Whereas these Bitcoins, how basically if you are aware of the blockchain, technology, you've been aware of the fact of this distributed computing and how these particular Bitcoins are being issued. So, unlike this particular currency that we happen to right now use it and circulate, these particular cryptocurrencies are not issued by any central banks or any central issuing authority, and that's a very typical difference. So, it's in fact, then why is that people are crazy about Bitcoin? It's as simple as that. So, there are some tech savvy people who would be willing to accept this particular technologically generated asset for the sake of facilitating various goods and services. As a reason, I already defined money is simply what people have been money. So, there are some tech savvy people who want to believe this as a currency and they believe it for the sake of facilitating various transactions. But as such, there is hardly any central bank in the world who happen to print and circulate them, and that's a very basic difference between the fiat currency that we use and these particular cryptocurrencies. Having seen what is money, the definition of money, and the functions money serves, let me also make it clear with respect to the various measures of money as of now in the country. So, when I discuss about monetary policy, I might have referred to something called 𝗵0, and I refer this 𝗵0 as high-powered money or reserve currency. 𝗵0 is high-powered money or reserve currency, mostly the currency that is printed by RBI and circulated. So, imagine the RBI has printed and circulated just imagine as of now the total money that's RBI printed and circulated, just imagine is worth 20 lakh crore rupees. That's the amount of money, 20 lakh crore rupees of money. But the total money supply in the economy not necessarily has to be 20 lakh crore in the economy. So, when we discuss about monetary policy, how the fractional reserve banking system would help in multiplying the credit or generating credit, and how that would result in increase in money supply. So, ideally, whatever the money printed and circulated, that is the 𝗵0 or the high-powered money or simply the reserve money is not necessarily equal to the total money supply in reality in the economy. So, there is a huge difference between the high-powered money and the reserve currency printed by RBI, and what exactly is the total money circulating right now in the economy, that is the total money supply. So, now let us go ahead and try to understand various types of money supply in this country, the measures of money supply. The first and foremost refers to M1. M1, the first measure of money is M1, and here in this case C stands for currency in circulation. Currency in circulation, and DD stands for demand deposits and other deposits with the RBI. So, if you simply sum up the currency, whatever is the currency that is being in circulation in the economy, and sum it up with the demand deposits that people have in the banks plus other deposits with RBI, that gives you M1. And M2 refers to M1 plus saving deposits with post offices. Most of you might also be aware of the fact, even in India, savings, post office also do accept some savings. There are various saving schemes offered by post offices, and if you are interested, you could also save your money with the post offices, and you get paid relatively a better rate of interest than compared to what banks pay. And then coming to M3, and keep this in mind, it's not M2 plus. This is something where many of you end up making a mistake. When it comes to M3, it is not M2 plus, it is M1 plus net time deposits with the commercial banks. I mean, when it comes to M1, we only included the demand deposits, but when it comes to M3, we are also adding the net time. Does mean it's simply the term deposits or what we call fixed deposits. And M4 simply corresponds to M3. Now, here in this case, it is a M3 plus total deposits with the post offices, including national small savings certificates. So, these are the four different measures of money supply. When it comes to M1 and M2, we refer this as narrow money. And coming to M3 and M4, we refer this as a broad money. So, ideally, when it comes to the total money supply, whatever the money supply that M3 corresponds to is what we happen to consider for the sake of looking into what exactly is the total money supply in the economy. Okay, so these are the 4 different measures of money supply. Having seen the definition of money and measures of money and the functions of money, let's go ahead with how in reality this so-called money printed circulated, and how the total money printed circulated ends up becoming a very large money base of the total money supply, and the actual money printed circulated are related. So if you look at monetary base, refers to currency in circulation plus the bank reserves, whatever the reserves the bank happens to maintain. So if you look at this particular image, the bottom part of it is simply the money that RBI prints and circulates and issues to the market. But if you look at the top part of it, is simply the money that is being created by the banks, okay, with the help of fractional reserve system. So this bottom part is the base money or high powered money, or what we call reserve money, and in reality the total money supply would be much broader or much more compared to the actual money printed circulated. So if you simply divide this money supply, the total money supply, with this high powered money, the number whatever you get is what we call as money multiplier. So that helps in understanding how much is the exact the rate at which the entire money got printed and circulated got multiplied. This is how we calculate money multiplier. So having seen the aspects related to money, now let's go ahead and start understanding the actual part of the discussion, that is banking system. So before going into banking system, in general, we happen to categorize all these kind of institutions as financial institutions or financial intermediaries. In general, we happen to call all of these institutions whether financial institutions or financial intermediaries, because if you typically look at all these particular organizations, they do serve a very similar type of purpose. They borrow money from the markets and lend money to the markets. So they raise money from the surplus holders and lend money to the deficit holders, whether it's a bank or a non-banking finance company or a developmental financial institution or an insurance company. They all happen to do very similar kind of job, that is they raise money from surplus holders and lend money to the deficit holders. So now let's go ahead and understand the broader difference between bank and an NBFC. Ideally, bank is simply registered with as part of RBI Act of 1934, whereas NBFCs are registered as companies as part of Companies Act. As of now, the latest Company Act thoroughly revised is 2013. So bank is registered as an entity with as per RBI Act, and Banking Regulation Act of 1949 is the one that that's what under which the RBI happened to regulate this particular particular banks, whereas NBFCs are simply registered as a companies as per Companies Act. Banks have a right to accept demand deposits, whereas NBFCs doesn't have a right to accept demand deposits. So these NBFCs doesn't have a right to accept demand deposits. Banks can create credit, whereas NBFCs cannot create any credit. They are not into any credit creation. Banks are part of payment and settlement systems. So they are part of payment and settlement systems, but whereas these NBFCs are not part of any payment and settlement systems. So the simple thing is that these are institutions are simply that are created as per Banking Regulation Act of 1949. RBI is the one which regulates them, and these NBFCs are created as a companies as per the Companies Act of 2013, and these are the various differences related to their functions. So that's a very basic reason banks do issue debit cards, checkbooks, whereas these NBFCs has no right to issue your debit card, checkbooks. And at the same time, since banks need to maintain these kind of certain amount of reserves to meet your requirements, whereas when it comes to NBFC, simply speaking, they doesn't need to maintain the obligations with respect to reserve ratios. It does mean banks are expected to maintain certain amount of cash in the form of liquid reserves, what we call as a cash reserve ratio. But the same thing, when it comes to the NBFCs, the same thing doesn't hold good, and they really doesn't need to maintain any amount of reserves in the form of CRR, isn't it? Because they doesn't happen to issue any checkbooks, or they doesn't entertain any demand deposits. So these are the broader difference between banks and non-banking finance companies. Before going ahead, let me also define what exactly is the meaning of developmental financial institutions. Developmental financial institutions. So I think you could be able to figure out an example for an NBFC, isn't it? So, and I don't need to give an example for a bank, but let's go ahead and complete this particular discussion related to difference between banks and NBFCs with a brief introduction on developmental financial institutions. What do you mean by a developmental financial institution? So let me give an example so that you could be able to easily understand it. Let's take the case of NABARD. So most of you know this. Okay, NABARD is an institution that is into the business of lending money to promote agriculture and rural development activities. So how does NABARD, what does NABARD typically does? It's again simply like a bank or financial institution. It raises money and lends money. The only thing is that this is an institution that doesn't lend money directly to the markets. This is someone who happen to finance various other institutions for the sake of promoting certain developmental activities. So NABARD many times raises money from the market, okay, or it happens to be funded by the government. Somehow it happens to raise money, and that's the money it happens to lend to the various other financial institutions, like mostly the banks or regional banks, maybe some commercial banks, for the sake of promoting lending in agriculture and rural development promotional activities. Similarly, we have National Housing Bank, we have Exim Bank, we have SIDBI, we have Industrial Development Finance Corporation, okay, Industrial Finance Corporation of India, sorry, and we have, in good old days, we used to have ICICI, like A as a DFI, and then there is something called HDFC, which has been recently merged with the HDFC Bank. And there is a difference between HDFC. HDFC is the developmental financial institution, actually the parent bank of HDFC Bank, and which has been recently merged with the HDFC Bank. So the developmental financial institution is something that mobilizes money and lends money to, not directly to the borrowers, it lends money to the various other financial institutions to promote various developmental activities. That's the significant difference between bank and NBFC and a developmental financial institution. Okay, now let's go ahead with understanding different types of banks. So we'll start with the types of banks based upon the ownership. Generally, before going into it, let me make it clear with respect to the difference between scheduled and non-scheduled banks. Scheduled. Many times you might have come across a scheduled commercial bank, isn't it? So what do you mean by what's the difference between scheduled and non-scheduled commercial banks? If you look at the banks that are part of RBI Act of 1935, second schedule of RBI Act of 1935. If you look at it, so those banks that are part of second schedule of RBI Act are generally referred as scheduled banks. They could be a commercial bank or a corporate bank, no matter whatever is the type of a bank. But if they are part of second schedule of RBI Act of 1935, they are generally referred as scheduled banks. And these banks typically enjoy the patronage of RBI. They typically enjoy the patronage of RBI. Whereas those banks that are not part of second schedule of RBI is what we refer them as a non-scheduled banks. Okay. Similarly, when it comes to the ownership of the banks, we again segregate the banks into public sector banks, PSBs, and then private banks, okay, and then foreign banks. So foreign banks are those banks which happens to be setting up their branches or their 100% subsidiaries within India. So if you look at public sector banks, recently because of the merger of lot many banks, you might be aware of the fact that there are almost 20, isn't it? Lot many banks have been merged, with most of these small banks have been merged with certain other banks. So you don't need to remember the exact number of banks, but when it comes to public sector banks, these are the banks where the ownership has been dominated by the government of India. So the State Bank of India and its associates, In fact, the first and foremost group of banks that has been nationalized by the government of India happens to be the State Bank of India and its associates. Later, you might be aware of the fact in 1969, there are 14 banks have been nationalized. And then in 1980, around 6 banks have been further nationalized. So all these banks that's been nationalized in 69-80 along State Bank of India associates together, where the government of India happens to have larger proportion of stakeholding, is what we refer as the public sector banks. Okay, and some examples of private banks include ICICI, HDFC, isn't it? And certain foreign banks like Citibank. So the other type of banks, having seen the difference between scheduled and non-scheduled banks, and based upon the ownership, we happen to categorize banks into public sector banks, private sector banks, and foreign banks. Now let's go ahead with the very broader difference between the other types of banks. One is a commercial bank. Very common types of banks is commercial bank. So commercial banks are those banks operate with a profit motive. Okay, operate with a profit motive. So most of these banks that we right now regularly happen to interact with is generally to be called a commercial bank. Okay, and the other type of banks is what we call as cooperative banks. So as such, this term cooperative is very much popular even in agriculture sector in India, isn't it? So you think I think you might be having a fair idea about the cooperative societies and how cooperative societies play a very instrumental role in promoting various agricultural activities, isn't it? Like the sugar industry, cooperatives are also very prominent, and when it comes to various other categories, let's say the dairy industry, the cooperatives are very prominent. The same idea when you happen to apply to the logic of banking, okay, and if these cooperatives happen to come together and initiate a financial institution which is into the business of raising money from the members within the society, or simply those people who happen to participate within the cooperative bank, okay. So these cooperative societies, okay, or these cooperative banks run by these cooperative societies more or less operate with a motive of no profit, no loss. So it doesn't necessarily mean that they never report profits or not, they never makes a loss, but their intention is not to simply make money out of it. So cooperative societies does mean when people happen to come together and initiate or float an organization for the purpose of serving the interests of those people as part of the society, and every person has the right of participation with it, isn't it? So that brings in responsible participation, responsibility towards the institution. And these cooperative societies, whenever they happen to float a financial institution that serves the interests of those people, okay, within the society and in and around that particular region, generally, okay, is what is the basic idea behind a cooperative bank. And these cooperative banks in general have a motive of no profit and no loss. So that's the difference between a commercial bank and a cooperative bank. And having seen the difference between a scheduled and commercial, non-scheduled bank and commercial bank and cooperative bank, let me also give you regional rural bank. In fact, it is self-explanatory. Somewhere in 1973, the government has, somewhere around mid-1970, government has come up with the idea of promoting banking services in the rural part of India. And as a result, the government has started promoting, directly with the ownership of government and participation of certain sponsored banks. The government has initiated the idea of promoting banking in rural part of India, and these banks are generally referred as regional rural banks. And in the recent past, as part of promoting financial inclusion in India, you might be aware of these two banks that have been very prominent, that is payment banks and then small finance banks. So what do you think is the difference between these payment banks and small finance banks? I mean, these two types of banks has become very popular in the recent past as part of government promoting financial inclusion. So payment banks are those banks which accept deposits, but they are not in the business of extending any credit. So they don't lend money to the market. So you might be thinking, how come if a bank doesn't lend money to the market, is going to survive? Because what would be the source of income to the banks? Payment banks is simply a concept extended or simply derived from this narrow bank concept of Narasimhan Committee recommendations. So these banks are typically into the business of raising deposits of certain small amounts, and rather than lending money to the market, they happen to invest this money in the government securities. So the advantage of simply converting all the money to government securities, though the government securities pay a very low rate of interest, but the chances of default is absolutely zero. So it does mean there are hardly any question of these payment banks accumulating non-performing assets, because they are not exposed to the risk of default or no credit risk. I mean, credit risk is absolutely zero when it comes to payment banks. And that was a very similar idea. And in fact, this is been more or less derived from a very similar concept that's been proposed by Narasimhan way back in 1990s. That's what is very commonly referred those days as narrow banks. And as such, small finance bank, this is small, self-explanatory. This does provide very similar, functions or services like any other commercial bank, but the only difference is that these particular small finance banks do operate or do happen to provide the services with respect to a relatively smaller amount. And the same concept you could extend it to what we call as a micro financial institutions. Micro financial institutions, many times MFIs, what you have come across. So the same logic holds good when it comes to micro financial institutions. They are again the financial organizations which provide all kind of financial services, accepting deposits, transferring money, or simply providing remittances, providing loans. But the only difference is that they do provide every kind of financial service, but the only difference between a small finance bank or any other large bank is that their services are relatively on a smaller quantity. That's the only difference. But as such, microfinancial institutions are not only into the business of accepting deposit and simply lending money. They do provide a very similar financial service similar to any other financial institution like a big bank or a small finance bank. But the only thing in microfinancial institution, the quantity, the amount of money they do accept or they disburse as credits or the service they provide is at a very smaller amounts, and that's the reason they are referred as microfinancial institutions. And coming back to payment bank, since these banks doesn't provide any credit, it does mean anyone in the market could simply have a bank account and could deposit money. But the only thing is that you are not you would not be availing any credit facility. That does mean you could have a debit card, but they doesn't issue any credit cards. So that's are the different these are the certain types of banks that we will have come across. So what we have discussed as part of this particular series is what is money and how money happened to evolve from commodity money, from barter system to commodity money to metallic money, and then people started using gold, silver, the precious metals as a medium of exchange. But as such, you remember the fact that if you are using gold and silver as a medium of exchange, these gold and silver would have a intrinsic value, isn't it? They have an intrinsic value. Even though king or the government says they no longer could be used as a currency, because they have an inbuilt value, they could be used as a medium of exchange. But the problem of using gold and silver as a medium of exchange is that they cannot be used, or every product or every good and service cannot be expressed in terms of these gold and silver, because they happen to be much precious. So later people happen to move from gold reserve system to fractional reserve system. And from fractional reserve system, they happen to move to minimal reserve system, and that's what's the practice as of now in most of the countries, including India, isn't it? And that's why we have seen various, how the money happened to evolve. Then we discussed about the measures of money starting from M1 to M2 to M3 to M4, and the difference between narrow money and money, broad money, and what exactly and how is money multiplier measured. Simply the money multiplier is equal to the total money supply divided by the monetary base, or simply what we call as the M0 or reserve money. So I could write this as M3 divided by M0, is the simple way to compute the total money multiplier in economy. Later we started understanding about the definition of a bank. Bank, a non-banking finance company, developmental financial institution, including insurance company. If you look at all these companies, does serve a very similar kind of services. That is, they are into the business of raising money and lending money. So if you think I have missed out, an insurance company, let's say something similar to a developmental financial institution, what does an insurance company does? Then an insurance company happens to sell various types of insurance policies. And in the form of selling insurance policies, they do raise money from the public in the form of premium. Is it? Whatever the premium we happen to pay in return for the policy we purchase is the source of money to an insurance company. And what do you think the insurance company does with it? Do you really think the insurance company happens to keep it in a locker and save it for the day? No. It does simply lend money to the markets. Maybe it would be investing in some other companies. You might have seen 𝗖𝐼C, and recently 𝗖𝐼C has gone for IPO and it has become really successful, isn't it? So that's what, even in 𝗖𝐼C or a non-banking finance company or a bank, everyone happens does a very similar kind of job, and henceforth we in general refer all these institutions as financial institutions or financial intermediaries, and we will be continuing the discussion with respect to this banking, money and banking in the next session. Thank you.